Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. David, a lot of news as always to get to, but first, we had a crew 9 strong down at the Toy and Joy shop at the Open Door Mission. We help out every year, providing some Christmas gifts for families that otherwise wouldn't be able to enjoy them down at the Open Door Mission. And then here at Retire Smart, oh my goodness, what a finish fling. Another round of estate and tax planning classes, and our new class, the Digital Asset Workshop. What a finish to the year, David.
Yeah, and then the last weekend we also had the first ever Smart Spend Down Solutions, which was amazing. So, I mean, just how many people we were able to give some valuable information and insight to here in the last 2 weeks is pretty good. But we're going to take a break from the classroom and fire some things back up for educational back in January. But the staff is like, okay, thank goodness, let's take a breather because we were open late almost every night the last 2 weeks.
It's
something going on.
It's a workout, but well worth it, and dozens and dozens and dozens of people coming through. And stay tuned. We'll start rolling out the classes for the first quarter here. Well, pretty soon, first quarter of 2024.
I fell under the weather and was supposed to go volunteer with you guys at the Toy and Joy shop, but I did see a picture of you crawling into like a crate or a box or something.
Well, they have these industrial-sized boxes on pallets, and you got to get the gifts out, the toys out, and sort them and put them in, 0 to 5 years old, 5 to 10 years old, and price ranges and things, and then people come through with a cart, and you help them get their toys. But yeah, not the most flattering picture of me crawling into a giant box. I guess it showed my best side. We'll just leave it at that. I thought I'd say it before someone else did out there. All right. David, you mentioned in our team meeting this week an uptick in merger activity, which you said might be a prelude to recession. What's happening and why?
So we start to see companies merge. We saw Occidental Petroleum take out buy a company, and that's, by the way, Warren Buffett and them. They're huge investors with Berkshire Hathaway into Occidental. But we see mergers happen towards the end of economic expansion because they see the credit markets deteriorating and going away, so they use these credit facilities to grab their last deal, right? Hey, I'm going to use the credit while it's still available and go borrow some money and buy a company. We saw an unsolicited bid for Macy's, the department store. We don't have them here locally, but they are, a pretty well-run retail store as far as department stores go. They're probably the best of the bunch out there compared to like a Kohl's or what have you, just from a financial metrics, looking at how they run, the margins they hold, et cetera. And so there was an unsolicited offer. It'll have to go higher than that for it to actually happen, but you are seeing this activity, and yes, that does typically happen at the end of an expansion cycle in the economy. So that is, again, just another data point pointing that maybe we are on the precipice of a recession. If you look at some of the data under the hood, I would say that's accurate.
Well, speaking of data points, recently the November job number came out, and here's the CNBC headline. U.S. payrolls rose 199,000 in November. Unemployment rate falls to 3.7%. Now, a lot of voices are heralding this as good news. Now, it seems to me you've said that 250,000 jobs is actually the benchmark of a healthy economy. Do you still hold to that?
No, absolutely, because that's just replacement. So we have a population declining problem here in the U.S. A lot of people don't even realize, even with immigration, our population is going down, and it's going to go down rapidly, and that's due to where we sit in the demographics with how many baby boomers are out there, et cetera. But so if we don't create over 250,000 jobs, the economy is not actually healthy. Now, this was a slightly better than expected number, so that's why it was good. They were only expecting about 170,000 jobs, and they got basically 200,000. And then people immediately like, oh, we're going to get our soft landing, and the Fed's going to cut rates, and we see all these talking heads on the financial shows. The Fed's going to start cutting interest rates. Isn't that awesome, Chip? Well, I got news for you. The Fed has 2 mandates. Full employment, and full employment, Chip, is described as unemployment below 4%.
Okay.
That's considered full employment, which we have, right? We have 3.7% employment. And then inflation at 2%, which it is not. So we just had CPI come out this week, and it was at 3.1% year over year. So that means we're paying 3.1% more on top of what we paid more last year, which was about 6% at this time. So again, we're still up over 20% in cost of goods in the last 36 months, but inflation is better than expected. affected numbers, and it was flat, and the PPI was flat as well. That's the producer price index. But here's the problem. Why would the Fed cut rates if the economy, if the job market's showing that it's still pretty strong? There's no reason for them to cut rates. So it's nonsense to think that with unemployment below 4.5%, you're going to get the Fed cutting rates. And so the only way they're going to cut rates is once we start to get job losses start to mount, which I do believe you're starting to see, and we'll see that roll into 2024.
Well, to that point, will this number hold? For most of the last year, we keep seeing the number then get retroactively revised downward.
Yes.
So we'll have to see if that 199,000 holds up. All right. Now, we may have to inaugurate a whole new segment of the show, David, called David's Data. You are a data-driven guy. You produce a constant stream of charts and graphs and observations for the team here at Retire Smart. And what we've done is pulled a few things out of that stream to share with our listeners here. I'm going to throw 4 things at you that you presented to us over the course of the last week. A credit contraction in the banking industry, a 2-year struggle by the S&P 500 just to get back where it was 2 years ago, a Bitcoin crash that may have a political coincidence, I'm using air quotes attached to it, and then kind of a humorous, well, it's a serious point of inflation, but with featuring Macaulay Culkin playing Kevin McAllister in Home Alone. Dive in, David. Break some of this down for us.
Well, let's start with that credit contraction. So credit is, when we say a credit contraction, that's how much credit is being allowed or extended to companies and individuals, right? Banks are willing to lend you money. This would be vis-a-vis a credit card, a line of credit, or just a straight fixed loan. And so the extension of credit usually means companies are borrowing money or individuals are borrowing money for something to purchase something, which is good for the economy. But as we said, we see the use of credit when we think it's going to go away at the end, all of the mergers we talked about a little while ago. Well, we've seen a contraction in available credit from all commercial banks to the likes we've only seen once in history since we've tracked this stuff over 50 plus years, and that was during the financial crisis. Credit contracted mightily during the 2008-2009 financial Great Recession, if you will. Well, we are now below the Mendoza line. We're in contraction mode. We're not expanding credit. We're actually contracting. And again, this is only the second time that's ever happen, Chip. That's not usually a good sign, right?
I love the baseball reference, Mario Mendoza. That is not an economist. That was a guy who batted 200. And so if you're below the Mendoza line as a batter, you're in trouble. If your economy is below this index that I'm looking at on this chart, and as you say, David, it was the Great Recession. We're getting down into Great Recession territory, according to this chart.
And we've seen the yield curve invert here this past week, again, accelerating, telling you that there is a recession.
That's in the
on
bond
the horizon.
market, right?
Yes,
The yield curve.
Yep.
Yeah.
And then the S&P.
When the short-term bonds are actually paying off better than the long-term.
Correct.
Right?
And that inversion started to unwind, and then now it's recently inverting more again. So it's going the wrong way. And the other thing I shared with you guys is that the S&P 500, like people are like, oh, the market's having a good year. Well, yes, it is, but it had a much worse year last year, and you're still not back to even. So the S&P lost over 20% in 2022, so a year ago, right? And this year it's up about 20%. So people think, oh, I'm back where I am. No, you're not. You're actually negative. So let me put this another way. If you have $1 million in your IRA and you lose 20%, Chip, in a year, how much do you have at the end of the year?
Okay, so you're down to 800,000.
Okay, and then if we gain 20% the following year, how much is that?
That's not going to bring 20,000 back. I can't do it in my head, but you're going to come up short of
160,000. So you're going to have 960,000. So you're still 4%, and that's about where the markets are, ironically, about 4% below their all-time highs still as we record this. So the market has gone nowhere in 2 years. Now, the problem with that is the longer it goes, the worse the downside may be, at least from historical precedent set. So could the markets hit all-time high? I don't know. We never claim to be great prognosticators, but I would tell you there's a lot of people that have been waiting to get even, right?
Yeah.
And so that's why stocks and markets don't just fly past old-time highs. They get there and they kind of go sideways for a bit because you have to work off the people that bought the index or the stock or what have you at that level in the previous high, whatever that was 2 years ago, 2 months ago, doesn't matter, because then they feel good. Oh, I'm back to even. I can get my money, and they sell, and that creates selling pressure, which creates almost like a bit of resistance to the markets. And so we may be coming into that period, and then if we get negative data next year, that could be bad. Now, earnings estimates have been brought down significantly, and this is a game analyst play so that they can say, hey, they beat their earnings, right? But they're really not beating a healthy estimate, and so the consensus is that the earnings estimates are not going to be very robust next year, 4 to 6% in earnings growth. So, are we willing to pay this high of a multiple for the market? We'll find out.
Well, I like your initial point. Don't let anybody trick you. Well, you went down 20%, but we've gone up 20%. If you go down 20, you got to go up 25% to get back to where you were, right?
Yeah, and if you go down 50%, which has happened in the last two big recessions, you know what I mean, or you go through the dot-com debacle and the '08 scenario, 50% plus retracements, you got to make over 100% to get back, Chip. And so that usually takes about 5 years. So make sure you understand the amount of risk in your portfolios.
All right, what happened with Bitcoin here, David? Is something fishy going on here?
Well, what was interesting, is we this last weekend, over the weekend, Senator Elizabeth Warren announced a potential new bill that she's going to sponsor, which is basically, negative for Bitcoin, how they want to regulate it and tax it, et cetera. And again, we don't make any recommendations on cryptocurrencies. We covered that in our class this week, but it's something we certainly pay attention to, and there's a lot of reasons why. But what was interesting, what I pointed out, is that Bitcoin dropped $3,000 from 40-some thousand down to like $44,000 to $41,000 per Bitcoin. In about 30 minutes, this happened prior to Elizabeth Warren making that announcement publicly. So
somebody knew something.
Somebody knew something, absolutely. So we talk about insider trading, et cetera, who knows? But yeah, somebody had that news and then played the positions accordingly. So again, that's the things we always want people to understand. There is a lot of data out there, and you need to pay attention and not make panic-style decisions. So,
well, speaking of panic, so here's the classic image of Macaulay Culkin, the Kevin McAllister Home Alone, hands on the face, look of shock on his face. And what's going on here, David?
Oh, well, so in the movie Home Alone, which came out, I believe, in 1990, okay, so that movie came out prior to me even being married, so that's 33, almost 34 years ago. He went to the grocery store with money, right, and bought some stuff and got questioned by are you here by yourself? It was kind of a funny little scene. And the bill, they rang him up, was $19.83. Well, some people have been replicating that over the years as a way to measure inflation. So this year, the items he had in that little sack would cost you $72.28. That's a 250 plus % increase in inflation. So I'd sent that picture out with him slapping his face with that data to you guys to kind of just give you an understanding how to make inflation real, or people to understand what it means. But the shocking part is, if you just went back last year, those groceries were only $44. So
it's like a 75% increase or something, isn't it?
So
from year
we're
to year?
seeing massive grocery inflation now, accelerating back into the market. So is inflation really under control? I would venture that it's not. And if you've been to the Hy-Vee or Baker's lately, you might agree with me. So
these are turbulent times, economically, financially. But don't panic like the kid in Home Alone. Just keep calm and get your report card, 402-369-7777. Complimentary review of your entire situation. Maybe you're in good shape. Maybe you need to make a few changes. Now's the time to find out. And we will offer recommendations for what you might want to do going forward. The complimentary report card, 402-369-7777. Up next, Retire Smart wants to be your one-stop shop for all your financial matters. That includes taxes. Abigail McNaney, who leads our division called Tax Smart, joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. The end of the year brings with it tax considerations. It's a good time to check in with the head of our division called Tax Smart. David, please introduce our special guest.
Thank you, Chip. Yeah, so we now have our resident tax authority in the studio this week. Joining us again is Abigail McNaney.
Yes.
And we joke sometimes we will sometimes use her maiden name, even though she's been married well over a year now. So
still getting used to saying McNaney.
I get it. You get a name, you get to keep it your whole life when you're a guy, and you guys unfortunately you ladies have to make that transition.
Yes.
So kudos to you. That would be difficult on me. I can tell you that. So, hey, listen, we're getting to the end of the year. So I just want to make sure we cover just a couple of maybe useful tax tips that our audience can potentially use over the next 2 weeks or so before we click the clock over to 2024. Wow.
That's crazy.
It is. It's thinking about that. It's like, man, that 2024 is going to be here. I would think we'd have flying cars, all this stuff. But anyway, so we just had another, and Chip and I were talking about it earlier in the show, we had another successful round of educational classes. We've had a barrage up here at the end, but we had our estate and tax planning class, which we talk a lot about taxes, in particular to the estate and inheritance taxes, et cetera. But we also just held our first ever digital asset class with Brad Starkin, our advisor who's got the certification for that, and that went really well. But I want to talk about people that might, just real quick, may have purchased things like cryptocurrencies and what have you, because they are readily available on apps. People are using things like Robinhood or even PayPal. You can buy it, or Coinbase apps. And so they're buying these things. And some people aren't realizing the tax implications, right?
Right. Yeah. And I think we see a lot of people, because it's so just available on your phone and it's crypto, it's new, it's exciting. We see a lot of people buying and selling this short term and not really realizing that that is taxed as income. So I'm
guilty of that. As you helped me actually set up all my stuff to prepare for my tax return every year, and I've got these trades and what have you. And
we'll be excited to look at that.
Yeah. Well, and they are. So depending on your tax bracket, and for me, unfortunately, I'm in the highest tax bracket. I mean, I'm blessed, but I'm also having to pay that highest number.
Right.
Between Fed and state, it's almost 44%. So if I were playing around in the crypto market and made $1,000, just say I bought trade on and crypto moved up and I sold something like Bitcoin or something, that $1,000 gain, I got to give up basically $440 of it on to the tax man, and people don't prepare for that. And then if they buy something and reinvest it over the new year, they don't have the cash available. They still owe the tax, right?
Exactly. Yeah, and that's one of the things with cryptocurrency is it is so volatile. So when you see that increase, you wanna move on it, but make sure you don't move too quick, and you think about what are the taxes that could come with this, and make sure that you're really ready for that, because again, it's volatile. It might go back up. Well, who knows?
Well, so we are in the holiday season, and what's going on at church. Usually, you see a lot of people increasing donations. So what's going on at your church, which, by the way, is my church?
Are we talking about giving or events?
Yeah, both. You can talk both. So.
Right. Yeah, I know for churches this time of year, it is our giving increases. So my husband's on staff at my parents' church, so I really get to see inside. And to be honest, giving always goes up, but also inflation has kicked in too. So we see the amount of people that have been giving recently has increased, but maybe the amount has lowered. So it's great that more people are giving, even though it's less. And so that's actually one great tax strategy for year end that we can look into. But
and the needs are great, because unfortunately the inflation pressures have made more people unfortunately need the help on the other side of the giving, those that are benefiting, and through our church. And so we go to the same church. Her Abigail's father, full disclosure, is our pastor.
Yes.
He hates it when call him Pastor Bart. He just likes Bart. But Flatlands Church, which is it's a great church if you're looking for a church home, by the way, off of 144th between Fort and Maple. But basically, we do see an increase. People do spread the love, so to speak, at the holiday season through wonderful charities, through the Salvation Army, the Red Kettles, through Open Door Mission. So all these great organizations and churches. But a lot of people don't realize is they can take advantage of the tax code by maybe even lumping. If you're traditionally someone that does do a nice, decent gift at the end of the year to your favorite organization, you could take advantage of something called a donor advised fund, and you could give a couple of years of donations into an account where it just sits on the sidelines and can be invested if you want, but then you can donate it to that organization, your church or charity, in the order you want, right? So over the next couple of years, but you could get the tax benefits today if you needed to pull yourself into a lower tax bracket. So there's one year-end tax tip. So what else do you have for a year-end tax tip today, Abby?
Yeah, I think the other ones are to make sure you're looking at your contributions to your 401k or IRAs. Again, here we always promote the Roth. Pay the taxes now so that you really get that tax-free benefit later. So again, giving and also, gifting as well. So you do have in 2023, a $17,000 gift kind of, you can give that away. And it is.
There's no tax implications, right?
Exactly.
So you can give to your kids, et cetera.
Yes.
Under the gifting rules.
Yeah. And then other things to think about are what, taxes are changing next year where it's a benefit to do different things. So, for example, our net investment tax in 2024 is going up to 5%. Previous years, it has been 3.8%. So for anyone who has income over $400,000, maybe look at paying stuff now, or if you need to sell stuff now, that's probably the better thing to look at.
So we've had the Magnificent Seven, as they've been called all year long. These are the big tech stocks: NVIDIA, Amazon, Apple, et cetera. These stocks, you may have a gain in there, but you have high income, and if you were to sell to take some risk off the table, you're going to get a different tax rate next year if your total income is over $400,000 between the capital gain and your income. So you really need to be paying attention to these things or working with proactive tax planners when you have assets to sell. And this includes real estate, businesses, et cetera. And a lot of people are just unaware that this tax exists. So this is on top of the capital gains rate you pay to the federal government. And in that example would be typically 20% for some people. Now there's going to be a net investment tax for some people as high as 5%. So now that takes their effective capital gain up to 25%. And here in Nebraska, another 6.64. So now you're actually paying almost 32% tax on a capital gain. That's not that tax advantaged for a lot of people, and they need to think this through because they could get a discount if they do it this year. Again, this is why pre-planning is so important before you sell large or highly appreciated assets. So let's flip real quick here to something a lot of folks that are not going to have to worry about that, won't have income that high, but are still itemizing their deductions because they're giving to charity. They have mortgage interest, so they get those are the two biggest write-offs most people put on what's called a Schedule A, right? But you can prepay, so you're capped at the SALT deduction of 10 grand, right?
Correct. Yep.
So if someone has, let's say, $3,000 in property taxes, $2,000 in interest from their mortgage, that's $5,000, and maybe they gave, or that's the SALT deduction. It doesn't include charity. Maybe they gave 10 grand to charity, so now they have a $15,000 itemized deduction where their standard deduction would be 13. So they could actually give another. They could actually prepay another year's property taxes. Right. The county will take your money.
Yes.
You can go prepay it and get to write that off this year. So you could accelerate this. You need to make sure you understand what your SALT limits are, your SALT deductions, and that's state income tax, property taxes, et cetera. So you may want to look at how to accelerate your tax savings. This is for year-end planning. And that's why people work with someone like you who's a proactive tax planner, right?
Right. Absolutely. Yeah. And that is a great way to do it. And that's what we look at here. We look at where are you at now? Where can we move? What cash do you have on hand? And that's really what we should be doing these last, few months and, now weeks of the year.
No. And as you get to the nitty gritty, unfortunately, a lot of people wait to the last minute and they'll be hearing this show, that'll air on multiple stations this weekend. And they may be too late to take action, et cetera. So you may want to consider, if you've never done it before, a Roth conversion as well. So in other words, if you have money in an IRA, you could move it to a tax-free account, a Roth IRA. Now, it's a taxable event when you do it, but you may want to fill your current tax bracket up. So if you were a married couple and you were earning, let's just say $100,000, your standard deduction this year is over $27,000. So your taxable income in that example is only about $72,000. So you could convert about $20,000 without leaving the 12% tax bracket. And you could move it from your IRA to your Roth IRA, pay 12% on those dollars now, stay in the same tax bracket, and those dollars will potentially be available tax-free. There's a couple rules, 5-year rule, 59.5. We got to make sure you understand all those. But you're going to come out so much better on the other side if you're proactive. But again, so many people wait and kick the can or put it off. Their procrastination in their tax planning is pretty regular, pretty commonplace, right?
Yes. Oh yeah, absolutely. And we see that all the time, and we're here to again help be proactive and help you with that. You don't have to do it yourself. There are professionals that want to help you. And really just see you succeed. Again, living a tax-free life is kind of our goal here. And sometimes you have to just pay the tax up front and bite the bullet in a sense, because the benefit later is crazy good.
Well, and what I find interesting is some people are not aware of tax penalties on Medicare, both Part B and Part D, which we cover in our Medicare classes. And so they think, oh, well, I'll be in a lower tax bracket when I'm retired. And of course, For most of our clients, that's just not true. And then as they get these bigger income distributions through what's called required minimum distributions, they end up having to pay another tax called IRMA, which is an income monthly related penalty on you're getting. The government thinks you have too much income. And it's not that big a number, folks. It's about $100,000 a person. So if you have saved $1 million in an IRA and then you start taking these RMDs, $40,000, $50,000, $60,000 as you get older, that on top of your Social Security and any other income you have will push you over an income threshold. Not only do you have to pay tax on the Social Security, you got to pay tax on the Medicare and on the distribution. 3 taxes on one distribution. And all of that could be potentially tax-free if you proactively planned and understood how Roth conversions really work, right?
Correct. Yeah.
So if you want to find out what's right for you and get a tax analysis, we'd be happy to do that. You can contact Abigail and find out what tax planning really looks like. You don't have to be a client of Retire Smart to provide for this service. It especially works well for entrepreneurs that have businesses that are starting to grow revenue and scale, and we can help them reduce their tax liability, which means more money to invest back in the business.
Yes.
Man, we are out of time already here, Abigail. So any other tips or anything, any holiday wishes you'd like to give everybody for the Christmas season?
No, just best wishes to everyone and enjoy spending time with your family and happy holidays.
All right. We'll have you back on after the new year. Thanks for stopping by.
You have questions? David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. Well, David, this is perfect. You and Abigail were just talking about Roth conversions a few minutes ago, and the first question is about Roth conversions, Roth accounts, and it comes from a fellow named Jim who attended one of our recent tax dinner presentations, Taxes in Retirement, and he was talking about an article that he provided for us that was trashing Roth accounts. Here's the question. So here's the article I mentioned. The author says she lost $400,000 and a Roth account is a bad move. I disagree, and I think you see things the same way I do. What's your take on this article? David, go.
So the article was written by a gentleman who has a blog called Derek Saul. And Derek Saul, full disclosure, has 0 licenses as far as I could tell. I did a little research. So he's not licensed to give advice, yet he's doing it. Find that interesting. But number one, he completely misses how the tax code actually works. So he assumes in his article that you are going to be in a lower tax bracket when you're retired. Now, is that true for the average American? The answer is no. Is it true for a lot of Americans? Yes. And those are unfortunately the ones that don't have any money saved. So if you took everybody in America, unfortunately right now it's over 50% of them couldn't come up with $2,000 for an emergency, right? Scary stat there. The clients we work with have saved, have put the time and effort in, paid their debts down, saved up dollars, and have saved in some cases significant amounts of wealth. And so when we talk about Roth conversions, we're talking about, listen, when you're in retirement, Social Security is going to be an income source for most people. Now, there's exceptions to that for sure. But the lion's share of folks are going to get Social Security as a piece of their income in retirement. Chip, does Social Security income get taxed?
It does now. It wasn't supposed to, but it generally does.
But it doesn't have to be, right? And this is where Saul, Derek Saul here, doesn't understand the tax code. He took no calculations into how Social Security gets taxed. So let's just say that a husband and wife are going to get $50,000 in Social Security income, and they decide they want to live on $100,000. So we'll just make it a nice round. So they pull $50,000 from, let's call it $1 million IRA. So now they have $100,000 in gross income. Well, that $50,000 they pulled from the IRA, Chip, is taxed as ordinary income. Under current law, that would be 12% tax if that were the only income they showed, right? But this 85% of that Social Security now also has to pay 12% tax. But if that $50,000 came from a Roth IRA, not only would the $50,000 distribution be tax-free, so would the $50,000 from Social Security be tax-free. So while he's having them defer into that account at 12% now, saying they're going to take it out at the same tax rate later, they're going to pay 24%. right? Then you got to pay the state of Nebraska on top of that. And on top of that, if their accounts grow enough, and again, most of the investors that we deal with, most of the folks we deal with have done a great job of saving. They want to conserve their dollars. They want to save it for a rainy day. They don't want to overspend or overdistribute. So they let these accounts grow. And then when you get to a certain age, between 70 and 75, depending on what year you're born, you are now also going to have to do what's called a required minimum distribution. So it may be more than you want to distribute if you have money in a traditional IRA or 401k or 403b. If it's in a Roth IRA, Chip, how much do you have to take out in required minimum distributions every year?
You can do whatever you want with a Roth IRA.
You do not have to take any distributions if you don't want. Therefore, you can only take what you really will spend. 100% of your income can get tax-free. Again, we can get about 38 to 40% of our clients over time, this doesn't happen overnight, to a tax-free income in retirement. He does not calculate, on top of that, the IRMA penalties. That's Medicare B and D. So, and in his article or on his website, I went there, he said that you'd have to raise tax rates over 80% to make it make sense. I would challenge Mr. Saul to come on the show. We can debate this topic anytime you like. We've got calculators and software that I've, spent my career developing, and we licensed other advisors. But take heed, folks, a Roth conversion is absolutely appropriate for the majority of folks when you do the actual math and look at all forms of taxation. And on top of that, folks, we have a guaranteed tax hike coming in 2 years and 2 weeks. It's already on the books.
You ran his numbers, and you showed me a couple of charts that showed, if he would do it our way, the Retire Smart way, he'd be about $400,000 better off.
Yes, and again, it's math, and it's pretty simple. But I think it's fine. He's trying to get headlines, if you will, on this blog, but he's absolutely making a mistake. And it's kind of like Dave Ramsey, another guy who I love his idea of getting people to get out of debt. He's done a lot of great things for a lot of people, but we talked recently about him being on the air telling people, oh, it's safe to take an 8% distribution rate, things like that. Again, if they don't have a license, just make sure you understand who you're getting your advice from. And if you're going to work with a financial professional, it does not have to be us, but we recommend independent fiduciary-based financial planners that are fee-based versus selling you mutual funds and variable annuities off commissions, et cetera, things like that. So make sure you understand who are you getting the advice from, and what licensings and credentials, those things does that person have before you just, I saw this on the internet, so, I should take heed and do this or do that. It can be really, really scary. And, we actually had somebody came in recently, Chip, and I don't think it was the gentleman that provided this article. It could be. I don't even know. But met with our advisor, said, no, thanks. I'll wait. They could change the rules or change the laws. Well, we have precedent, and we have historical data, and that's how we make our decisions, off of data.
Well, thanks for the question, Jim, and for providing the article. David, the next question is about drug prices. The Biden administration is claiming it has march-in rights to override patents and cut prices for certain drugs. I like the idea of lower drug prices, but I worry about the precedent for government to lean into whatever market it wants to control prices. Am I borrowing unnecessary trouble? David, march-in rights? I didn't know this was a thing. What?
Yeah, this is ridiculous. They're trying to almost use like wartime powers when we can tell you, hey, we want you to manufacture. Like, remember Trump was trying to get some of the auto manufacturers to make respirators when COVID hit, right?
Okay.
So there are things that you can do to help, when we need unprecedented things, but this is not one of them. This doesn't qualify, and this is them just overreaching for political, this is political capital they're spending here. They're just trying to, just like the student loan debt thing. Hey, we want to cancel this debt. And they keep saying that. You're not canceling it. You're transferring it, right? You're putting it on the back of the taxpayer. That's all you're doing is transferring the debt to those that did not agree to it, did not sign up for it, and should not be obligated to pay it. So if you want to cancel your student loan debt, that's fine. I tell you what, we'll just raise everyone's tax rate 10% marginally that gets their debt canceled. So therefore they pay it back anyway. There's a way to solve this. Hey, technically your debt's been canceled, right? So, this is, again, a big overreach by the Biden administration. And again, they are trying, the Biden administration, I don't know if you caught this, Chip, in the last, 30 days, they have changed the tone with which they're sending messages. Like we had CPI come out this week.
In what way?
And instead of, price gouging, we talked about this a couple weeks ago. He talked about companies.
Yeah.
Now he's talking about, hey, we want to work with companies to make sure we're getting junk fees out. He's trying to soften the tone because the political rhetoric is going against him. Bidenomics, by far, Americans do not believe is working, regardless of what they're trying to say from the podium at the White House. People are believing the economy is in worse shape than it was a year ago. ago and 2 years ago, and when Biden took office, over 63% of Americans feel they are worse off today than they were just a year ago. That's a pretty big number. And so they are losing the economic battle, and they fear for the election, which will be in just under a year, that could be problematic. I thought it was interesting, too. One of Biden's biggest supporters, a big crypto investor, starts with an N. I forget, I'm forgetting his name right now. But he gave over $200,000 the last cycle to Biden, big PAC supporter, and did fundraising. He is now on the gentleman from Minnesota, and I'm trying his name, Democratic nominee, or trying to get in the presidential race. So he's trying to get Biden out of there and put somebody fresh up. So, there's telltale signs right now that the economy is really going to be the Achilles heel for Biden going into that election. And so they're going to pivot to someone else. We've talked about that. Or they're going to soften their tone and try to, sell the average voter that things are well, which I don't think they are.
David, we're out of time for Q&A this week. How many discovery calls do we have on the calendar?
Just 4. So, we get to this last bit of the year. Our guys get really, really busy, and we are trying to bless and give some of our folks a little hard-earned time off, et cetera. So just 4 of those. This is where you're going to get 15 minutes with a licensed advisor. Ask them anything you want.
402-369-7777 to schedule a discovery call. 402-369-7777. Up next, federal and state governments keep pushing for electric vehicles, but as founder John Adams famously said, facts are stubborn things. The latest on electric vehicles is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Electric vehicles, David, I'm going to hit you with 2 headlines here. One from Fox News. Michigan Governor Whitmer orders state government fleet to be 100% electric. And then a headline from Zero Hedge says, 0 public EV chargers built since Congress approved $7.5 billion to expand network. Well, those 2 headlines don't seem to reconcile. What is the reality? Facts are stubborn things, as John Adams said. What are the facts, David?
Well, number one, the money was allocated over to the Federal Highway Administration to build these public chargers all over our interstates, et cetera, and main roads and thoroughfares. And 7 states have already been awarded over $100 million, and not one charger has been produced. Not one. Where'd the money go? Again, this is wonderful government accounting. People should get so up in arms over our government spending, regardless of political party, et cetera. In this day and age, the entire federal budget should be simply on the books, right? On a website where you can go and drill down as far as you want to go down. It's absolutely ridiculous that we've spent this money and got nothing for it. So it's gone to companies that are doing research into, well, we're going to figure out how to construct this. Well, if it's not ready, shovel-ready project, the politician's favorite word, right? Why would they, give them the money?
So you're just banking a bunch of federal cash to do research, but you don't actually have to build anything because nobody has any confidence that this is maintainable, sustainable, doable.
Well, on top of this, the public has spoken. We don't want EVs. It's not this, oh my gosh, I can't wait to go buy an electric vehicle. Now, I have friends, we have employees that have EV vehicles, but it's not their number one or main port of transportation. And we've talked about car dealers can't sell them, right? They're having a problem. People don't want electric vehicles because the problems that they still have. They don't have the range. And again, the Michigan thing, right? So Governor Whitmer says 100%. Now, I don't live in Michigan, and apparently I can get in trouble for just some of the things I said. We've talked about that earlier.
Yes, watch out if you travel to Michigan.
Yeah, there's a law there, and I was there not that long
hurt
ago.
People's feelings in Michigan.
Yeah, if you hurt somebody's feelings, you can go to jail or get fined. It's ridiculous, but they get a little bit of snow in Michigan, from what I understand, right?
My sister lives there. She's married to a dairy farmer. They get snow. They get winter in Michigan.
So can you imagine if 100% of the emergency fleet, all the government vehicles, the fire trucks, the police cars, the ambulances are all battery operated and the battery goes dead? What are you going to do? I mean, It's insanity to think that you would push this initiative so hard that this would happen. Now, do you want to maybe make school buses electric or something? Start with some. I got no problem if we make initiatives and incentives to slowly walk into these things, then it's fine. It's just like at the COP28 or whatever they call it. It's the World Conference on Carbon Emissions, whatever just happened, and the Saudis were there, and there was a big deal made of it, a headline, because they're going to eliminate emissions by 2050 instead of reduce. So that was the big thing. They changed their terminology. Of course, that's a joke because it's almost 30 years out into the future, and everybody talks about these carbon emissions, and you have 12-year-olds sitting on stages and at these places and save my planet, water rising. I'm like, I was in New York earlier this year, and the Statue of Liberty, curious, it's been there a while now, right? The water's not risen 1 inch on Ellis Island, not 1 inch. I'm just curious. How is that possible, right? If we've got all these rising sea levels, et cetera, I don't remember them having to raise the Statue of Liberty. Do you?
Not yet, anyway.
So again, data, as you said, data is real and data matters. And the data shows the public does not want to be forced into electric vehicles. By the way, I love when you see pictures of, electric vehicle fuel going down the railroad tracks. That's coal, by the way, right? Now, we did talk last week that they are now coming full circle back to something we've been talking about forever is, nuclear power,
energy.
right?
Yeah. Mm-hmm.
So what does that do from an investment standpoint? Well, I will tell you, uranium, which we do hold in a portfolio for a lot of our clients, is a valid thing to be looking at. If we're going to go heavily into nuclear power, uranium will probably do really well over the near term future. Is that it's a necessity. So anyway, it's a bit of a joke that they're doing this, but I mean, I just could not believe, if I lived in Michigan, I couldn't stand for this. You call 911. Well, we're charging. We'll get there when we can. Or you're stuck in a snowstorm, and there's blizzards where people get stuck. Right here on I-80 in western Nebraska, people have been stuck in their car for hours and hours at a time. Are you going to be comfortable if it's only a battery that you have to support your heater, et cetera, in your car? Anyway, so lots to unpack there.
Well, and the sheik, I don't have the story in front of me, but the sheik in the country hosting that global climate summit said, yeah, it's inevitable that we'll move on from fossil fuels, but not yet. There has to be a realistic transition process. Or he said it's people at the lower end of society who are going to suffer if we just take away the fossil fuel sources for them right now.
I'm just curious why we haven't heard a headline on the strategic oil reserves being filled, because oil did break below $70 a barrel. They told us we'll buy it back at 70. Well, you had an opportunity here this week, and I have not heard it as of yet. And of course, I'll wait and see the headline when it comes out.
David, in the time we have left, I want your take on this article you sent me. The CNBC headline is House Panel Subpoenas Vanguard Arjuna in ESG collusion probe. So there's not a collusion probe on Capitol Hill. This one doesn't involve Donald Trump, David. It involves that's environment, social and governance policies. Are they running afoul of antitrust laws?
Well, they are, because they're colluding to make sure that, and again, BlackRock's another one that was, people been talk about these things. They are colluding to, hey, we're only going to invest in the companies that are going to put things inside these index funds in companies that listen to what we say. And Larry Fink, the CEO of BlackRock, was on record saying we're going to force them to do it, right? And they are absolutely colluding to force actions that not all investors and shareholders of these underlying companies are in agreement with, right? And we've talked about ESG. Listen, nobody I know is like, let's mess up the environment. Nobody's proactively trying to go the other way. But this is just an additional compliance and additional expense. And now the government wants to get involved, and what would that do? It would add taxes and fees to regulate, we want to see what your emission levels are. And this just adds cost and expense, which reduces returns. And that's why some of these lawsuits have come about. And we've seen several of the largest investment houses being sued over this. And now we have Congress finally looking into it. And basically in this story, Jim Jordan, the representative for Ohio, just says, hey, you guys are just playing around because they data dumped so much data on them and they subpoenaed them. It's like you watch the old court thriller movies, right? They bury them into the discovery, and, they send over 3,600 different document sets over to them, which will take them, take you an army of like 100 law students to probably a year to go through. So, anyway, we'll see what comes of it, but not good news all around. And again, it just adds to expense for investors.
Well, we'll keep an eye on that. It's part of the comprehensive analysis we do in that complimentary report card. If you'd like one, 402-369-7777. 402-369-7777 for a complimentary report card. David, bring us home.
Hey, have a blessed and Merry Christmas and a Happy New Year. We'll talk to you soon. God bless.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.